and this is what really worries me. When it comes to the workout business, Peloton's got some very serious competition, whether we're talking about the existing gym chains like Planet Fitness, which nobody like if it's going down a lot, though Lifetime, now private, Equinox, or in-person exercise classes like SoulCycle. Again, you can't own shares in that. Or personal trainers, or even something like Fitbit. To say nothing of other companies that make exercise machines. I know they vehemently disagree with that characterization of themselves. They think they're in the business of making home entertainment machines that make you look great for a small monthly fee, the opposite of showing up at a gym that you don't want to go to. As for the subscription side, there are already half a dozen apps that provide a very similar service, and most of them are a heck of a lot cheaper than Peloton's, without the huge upfront cost of actually buying a new treadmill bike, a new stationary bike or treadmill, although I have to admit, they're attractive. There are a couple other major negatives here. For one thing, this is another IPO where the public shareholders will have hardly any voting rights. There's a dual-class structure that puts all the power in the hands of insiders. Hey, look, the market rebelled against that kind of thing with WeWork. Once again, I think investors are sick of this kind of stuff. The other big problem, Peloton's being sued by a group of musical publishers who allege that the company's using music their artists own without permission. Peloton seems to recognize this is going to cost them, although at this point we don't know how much. Still, even with these negatives, again, I'd be happy to recommend this stock at the right valuation. There aren't many companies with 100% plus revenue growth that's accelerating. But even after pulling back today, Peloton has a $7 billion market cap, which means it's selling for roughly 5 times 2020 sales estimates. Too rich for an entertainment in-home health machine. Now, it's hard to find a good comparison here. Peloton's growing like a high-flying cloud computing stock like Zoom Video, which trades at 37 times 2020 sales. But it's a very different industry, and Zoom is down big from its highs. Again, I think Peloton may have missed its chance. It's just not the kind of stock this market wants. It's been left behind by the Wall Street fashion show, people. Unless the investment bankers start pricing these IPOs a lot lower, institutional investors will continue to greet them with the skepticism that Peloton got today. It will become the norm, not the exception. The bottom line, this is not the kind of market where you want to rush into a newly minted growth stock like Peloton. If you think this stock is enticing, just be patient. I'm betting you'll get a better price. Hey, maybe somewhere between 17 and 23. Until then, wait, because we're in a treacherous market for fast-growing companies with big losses. Until that mindset changes, Peloton will trade like a money-losing extra cycle company with no soul. In other words, stay away.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.